there's a stigma that goes around that hard money lending is just way too expensive. They get sticker shock. A lot of borrowers just get sticker shock when they see, the cost of capital. Someone asks, how much does this cost? And you tell them 14%, right? 14% interest rate seems high. Banks lend out at 3, 4, 5%.
Sure.
Why is it so high? And the answer is, that's based off of a year, right? 14% is a year loan. Most of our flips are only 3, 4, 5, 6 months. So it's really significantly less than that. But also there's a big cost of doing business and getting capital for a deal. So let's do a quick breakdown. Let's say we lend $100,000 to a borrower. The after repair value is $150,000. Forget how much cash they're bringing into the deal. Chances are they're probably only bringing 10 or 15 grand into the deal. So there's a huge benefit on that as well. But regardless, if they're doing a flip, and let's say it's a 5-month flip, which is probably about average, we charge 4 points on the front. That's $4,000, right? Into the transaction so far. That's $4,000. 14% divided by 12, because 14% over 12 months only ends up being about a point or so per month. So you do another 5% to that because you're out for 5 months. So you got $5,000 plus $4,000 is $9,000, and then you have some other miscellaneous stuff, so another $1,000. So it's costing you $10,000 total to borrow $100,000 in order to get into a transaction that you might not have been able to get into anyways.
So now that 14% really is what, 10%, 11% is what, roughly what it works out to be.
Yeah.
I usually explain to people, going along the lines of exactly what Jay just said, is the faster you are with your money, the faster you are with your operations, and the better you can execute, that speed to you makes our money cheaper. So the more experienced guys, or even the ones that they know how to execute well, that are in and out in 5 or 6 months, our money becomes incredibly affordable. They want to get as much of it as they can because it's not the duration of the 14% that they're looking at. It's, hey, if I'm in and out in 5 or 6 months, this thing's costing me around 10%, give or take. That's almost free money.
Yeah, so. And especially if you do a cash-on-cash return, which we can get to more in detail in another video, but the rule of thumb is it's going to cost you $10,000 to borrow 100 grand. You're reselling it at 150. On a deal like that, you're probably going to make $40,000 gross.
Sure.
Take out the $10,000 profit, you're making $25,000 or $30,000, off your $10,000 original investment. Obviously, banks need to make money, private lenders need to make money. There's costs associated with all that. So don't get sticker shock just because it looks like it's a double-digit interest rate.
Right.
At the end of the day, there's a reasoning for it, and it's typically because it's a heck of a lot easier money to get available, less cash out of pocket. We already went over all the benefits of it.
Right.